If you've been following these videos for a little while, you'll know that there's two things I often talk about. The need to have a bulletproof balance sheet and a rolling three-way forecast. Now, in the last video, we looked at the rolling three-way forecast when we did our P&L deep dive. In this video, I'm going to walk you through the balance sheet reconciliations for Archi-Demo. We need these balance sheet reconciliations to be tight so that we can trust the metrics that we're getting from the P&L to manage the performance of the business. This is a very important step. Anyway, sit back, grab a cuppa and enjoy the video.
Here's Archi-Demo's balance sheet. You can see here on the left of the screen, we've got our opening balances for June 30, 24, and we've got highlighted there the July month end. We need to make sure this is bulletproof so there's no profit leaking away out of here. The first thing, we go to the bank accounts and we can see we've got a bank account reconciliation here for the main account, the 500, and we've got zero feeds coming through for the other accounts. Trade debtors again. So the stuff I've coloured in light green here, they're sort of like system integrated reports that you can run off. So the trade receivables, we can get into that. We can see the aging on it. We then come down, we've got prepayments. What's that 85 made up of? We've got unexpired software license stuff. We've got PI insurance down the bottom. That's making up the bulk of the thing. There was a small out of balance in the opening balance. I've got to get rid of that in August and write it off. We've got our two directors' loans. We can see there's no movement between the months on the loans. So we've just got them as opening balances, opening balance there again. We've got our fixed assets. Now we can run a reconciliation report off for that. And that'll look something like this, where we've got our costs, we've got our depreciation. We can tie that depreciation figure back to the P&L and make sure that that's all right. Trade creditors, same thing. There's a system report for that. PAYG, we'll do a rec for that. And that's from the July payroll. So that hadn't been remitted by the end of July. We could look up and see what the subsequent payment date of that was. Same with the superannuation. So there's 35 grand sitting there. That's the SGC superannuation. Expense but not paid during the month, probably paid early August. Then we've got the GST, and we can see that that's just the movement in the July, everything cleared out from before. We've got our income tax provision, so that's our year-to-date profit that we had from our three-way results, and we'll just pull that up again. There's our income tax before, 66,238. 66,238. So our income tax provision spot on. We've got a bank loan facility at the end of the month, 250. We've got credit cards, and we've got software and insurance premium funding, so we can go into those loan accounts and verify those balances as well. We've got staff leave entitlements, so we might get that out of the provisions. We've got the 65 for staff, we've got the 25 for bonus, and we've got accrued expenses in the accruals, and that's for subconsultants billed but not invoices received or paid yet. And that sort of rounds out our balance sheet. So that gives us comfort that there's nothing hiding in here that's going to come back out and hit us in the P&L some stage down the future.
Well, each month I'm going to keep updating these videos. I'm going to do one that's the P&L deep dive. I'm going to do one that's the balance sheet reconciliations. I'm going to do one that's a comparison of the detailed revenue forecast back to what we've got forecast. And the final one will be having a strategic discussion that we finally got enough information that we can actually talk about the business. I'm David Dillon from Custodian Back Office. Thanks very much for watching.